So hello and welcome to the Q3 2022 review. There's been a lot going on in the markets, a lot of pessimism. So let's take a look at what happened. I'll show you a little bit of the information that I look at, and then we'll take a look at maybe the psychological effect of this and maybe a key takeaway to keep in mind so that we can keep both yourself calm and keep those around you calm as well. First thing I wanted to show you before we get into the numbers is the way that I look at stocks. And it's a little bit different from the way that maybe you're taught, because you're taught about the price of it. More experienced investors look at one thing, and that's what it's worth. This is, you may have heard of Morningstar, but what you have here is all the companies that these guys do analysis on. One of the biggest companies in the world that does analysis on tons of stocks, and they try to come up with a intrinsic value. That means what it's worth, and that is different from the paper value of what it's trading at. So what we saw in late 2021, these ratios was in this section around that, I think 1.09 or something like that. So they're a little bit overvalued. And what are we seeing today? So today we're now strongly in that undervalued part. What it means is for every dollar of stock that you buy, you're paying currently 79 cents for it, approximately. And vice versa, when it was overvalued, you're paying more than what they think it's worth. So that's a good way to look at it. And that's why it's so important to understand that we still hold the underlying companies, right? Like that's what a stock is. It's part of a company. Just because it's currently trading for lower than we may think it's worth, it doesn't mean we have to sell that company. And that's why you'll always hear of during these down markets to stay invested. The next thing I wanted to look at was just historically what we've seen. So what you'll see here is throughout history, there's been times when the stock market is overvalued, according to Morningstar. There's times when it's undervalued, according to Morningstar. And I just want to point out not the fact that there are these times, but that it's very common. So up here is what I was referring to. Then we have this time here when it was pretty overvalued. We then, what you can see, times that was COVID. Prices came down sharply. It then came up. So this is the end of 2021 era. So what we see is that it goes swings and waves and roundabouts for times when it's been overvalued and undervalued. But it's important to note that it's normal, it happens, and a lot of uncertainty is what causes these types of price swings. So now it's time for us to actually take a look at what's actually happened. So here we see on the first line here, we have the last quarter, the returns. What you'll notice is, so the US is up a tiny amount, but mainly what's important is just to look at these year-to-date numbers. So we see Canada's down around 12%. This is just the index. We see the US is down. We see Europe's down. Emerging markets is down. Real estate, equity is down. The part that is hurt people the most is going to be the fact that stocks and bonds are down together, and that's pretty rare. Typically, what you see is bonds will go up when stock prices come down, but in this case, because it's kind of intentional, with them raising interest rates, what we're seeing is bond prices come down, which you expect when interest rates go up, and stocks down together at the same time. That meant that for those people that were maybe used to a more even experience, maybe in like a low risk conservative portfolio where they're holding maybe 70% bonds, it means you're still down overall like 15%, and a balance fund is also down around 15%. And like it's happened a few times before, but it's very rare. Typically stocks go one way, bonds are going the other way, and we use it as a safety net. But that hasn't been the case, which is why it's so important to do the planning. And that's why for those of you that are pulling money out of their accounts and taking an income, that's why I was so adamant on holding plenty of cash, so that when this type of thing happens, not that you could foresee both of these happening together, but if it did happen, we're okay. And that's why I'm not worried about you folks yet. We still got, a year and a half, 2 years until we've used up that cash before we need to sell anything. So that means we're in a pretty good position. And for those of us that are in predominantly stock portfolios and we're on the growth side of our lives, and that's where we're focusing on, it's a buying opportunity. And as we looked at in the previous slide, you saw the valuations. So I'm always going to say it, but it's a phenomenal time to buy. This is, as I said, it's the bond section that's really hurt people. This is just the last quarter, but what you'll see is as interest rates are going down, this is year to date, it's pretty steady, I guess, on what these bonds are dropping, the valuations of these bonds are dropping, and that's because it's more of a mathematical thing than unlike stocks where they're traded on what people think they're worth. This is very tied to interest rates and inflation, and these are things that we knew was coming. It was expected, and it's not something to be overly worried about. Because think of it this way: so for these maturities that are in the 1 to 5 year range, these maturities in the 1 to 5 year range, as they're maturing, they're being purchased. Further bonds are being purchased, and they're getting the current interest rates of today. So if interest rates were 2% when they were purchased, they're now being reinvested into bonds that are earning 5-6%. So increasing interest rates on the bond side of portfolios, especially for the income investors, the low risk investors. Yes, it may look like a negative today, but over the medium term, it's definitely a positive. And also, we buy bonds for one specific reason, and that's vastly, most of the time, that reason is for the income. So that income hasn't changed. If it was a 2% bond 2 years ago, you're still getting that interest payment. It's just the principle. If you're going to sell it, then it's worth less. But for those of us that, and a lot of the managers, when you're holding it to maturity, it doesn't matter what it's trading for a day before, because the company that you lent that money to is going to give you back that $100. So it's important to note that yes, bonds are down, but the income stream is still very alive from bonds, and that's predominantly the reason that bonds are purchased in the first place. So overall, everything is down still. Nothing's likely to change in that anytime soon. We're still waiting to see better inflation reports, and that will likely provide a bump in the markets, because there'll be a light at the end of the tunnel. But it's already happening. We're already seeing, when you look out at what the market's saying about expected inflation, it's back to around that between 2 and 3%, which is more in range and what's normal. When we're looking at GDP growth estimations, it's positive, in 2024, 2025. So that there's a lot of good, I guess, that the market is thinking is going to happen. But it's still pretty pessimistic for the now, and a lot of that is driven by this unknown. It's driven by uncertainty and the fact that a recession hasn't been called yet. When you look at history, though, recessions are called almost by the time they ended. It's months after that recessions are officially confirmed, with a start date and end date. So don't expect to see that anytime soon. And I wanted to stress that point. A lot of the reason that people pull out of markets is that it's scary and they're waiting for good news. And I wish markets worked like this. But we're going to take a look at COVID. So in COVID, we had COVID, right? In COVID, we had the news and the markets tanked, right? They kind of fell off a cliff, and it was all bad news. And a lot of people that maybe sold at that point, so scary or whatever, they were waiting for what? Well, typically they're waiting for this good news part, right? So it means that we would truck along hearing bad news, and then good news would happen, and suddenly the markets would rebound because it's over. Great, in theory, but what actually happened? Well, what actually happened was COVID hit, I think it's arguable whether they've even said that it's over yet. But so we saw the big down, and then we saw a little bit of flat, and then slowly over the next little while, it came back, right, and there was caused there was like a vaccine here. Like in this part that made it drop a little bit and come back up. Like there was a lot of noise around it. There was a lot of numbers. There was later on there was a recession told, but the whole point of it is by the time the good news comes, um, the markets have already factored that in, and the markets have already reacted to that, and that's why it's so important not to be out of the markets for really any period of time, because you have no idea when that's going to come. You have no idea when that rebound is going to come, and when you look through history, what you notice is that the biggest ups come after the biggest types of downs. But there'll be a separate video on that later. But as always, if you have any questions, if you have any concerns about your situation personally, please reach out to me. That's what I'm here for.